This is a recording. I will be creating few modules for the MBA 600, the Intro MBA course. In there, we have in week 4 and week 5, finance, basic overview that becomes the foundation for this class and also for the later classes. So in order to make these files small enough to keep it under half an hour, I have broken up into modules, and I will basically try to stop the lecture in each module at around 20 to 30 minutes. And so in this module, what I will cover is an overview of finance in our MBA program. Why do we include it in the intro class? What else would you learn about finance and apply it, and so on. Then I'll talk about the income statement in more detail, and then I'll stop at the end of the income statement, and then I'll continue with the income statement in the next module, where I will be using Excel to show some of the exercises. So starting with the finance in the MBA program, where will you be using finance? We will start with the overview and basic knowledge in this intro class, and this is the first module, and you will be hearing from me in class for the on-ground students, and these modules are be posted by Professor Peros for the online course, and again these will also be posted for the on-ground so they can go look at it again. The knowledge that you will acquire in this class will be included in marketing course. You have to have some knowledge and be able to apply finance. How do you figure out what the prices should be, what the price growth will be, how do you figure out how many units of your products you should sell, the break even, and so on. Then you'll use some finance in a research and analysis course. If anyone of you are planning to take investment risk management class, which I will teach, this has to do with how do you look at your portfolio, your 401k, how do you understand the risks associated with it, and so on. A little bit of finance in that is also useful, so this intro class finance will be helpful over there too. And again, finally, this becomes the prelude to the finance course, which is the 8 weeks of finance course that I teach, where we will take this intro level stuff and kind of build from there. So in the MBA 634, which is the more expensive, getting into more detail, that will build off the knowledge you're learning in the intro class, and then from there you can apply it into the more advanced courses, which is the growth strategy, the entrepreneurship business plan, and then finally the management strategy, which is the capstone. So what is finance? If you look at a dictionary like Webster, it'll say science of managing money or other assets and liabilities. Where we want to think as managers and leaders in a business is that finance is a skill, ability, using the knowledge to analyze and synthesize information and the data, and we use it to make decisions. So this is not accounting. There are no debits and credits. It's where you put it, the left side of the ledger or the right side of the ledger. This is more about how do you use numbers, how do you use finance to be able to make decisions, and what this intro level and then later on in the more expensive finance course, our goal is to be able to teach you how to use information to make decisions, using numbers. Now, let's look at it from a holistic perspective. Let's see if we look at a business planning process. Any business, be a startup business or could be a new product in a company, there are pieces of the puzzle we have to put together. So if you look at the chart on the left side over here, where my cursor is, that's where you would be looking at the product from a marketing perspective. The market, the competition today, in the future, what are your products, how would you structure it, what are some of the external environment to think about that may apply to your business. For example, do the oil prices matter a lot to your business? Do the interest rates matter a lot to your business? How about the unemployment? So from there, you come up with a marketing plan. So a lot of this thing will be covered from a marketing perspective in the marketing class and later on in the growth strategy class. But then obviously you have to worry about the financing. You know, if it's a new project, your cash you would need, your expenses, your budgets. When do you start to make profit? At what point do you break even? You know, and then so on. So it is really, really important that a business person has some knowledge so they can understand it. So even though they may be working with their accountants or they could be working with their finance person in the company, by having the knowledge, they are better equipped to be able to sell their projects, to be able to sell the projects could be to a bank or investor or senior management. So the finance becomes very, very important in order to not only successfully create a project that will make, you know, some return or profit, but also the knowledge of finance will also help you to be able to sell this project to the stakeholders. So from an organizational perspective, if you think about it, you know, we look at an organizational chart and we see some boxes and we see, you know, you got somebody running the business, could be a CEO, could be executive VP, whatever. And then you have some pieces of the puzzle, could be research and development, be engineering, marketing, manufacturing, and so on. So we imagine them to be connected through quote unquote organizational structure. But the way you want to also start to think about it, there is a connection also in terms of numbers, the finance, and it is connected from side to side and up and down. Because if you were in, for example, in an HR function, your department has a budget, they have to stay within the budget. If you are in marketing, you will have a budget for marketing, for advertising. You will have also some targets for sales. If you are in engineering, you will have some targets for engineering. So all these things organizationally are also connected from a financial perspective. So even though you may be in HR function or you could be in the marketing function and may have no desire to do anything but marketing for the rest of your life, but understanding how it is connected from a income statement and from a balance sheet perspective makes you a much better marketing person. So when you are trying to sell a business plan or trying to sell a new strategy in your company, or to an investor, understanding how they are connected will help you become a better business leader. So as far as the textbook for this intro class for the finance module, as you all have it and hopefully have read most of it, and again, finance is covered in week 4 and week 5, and this is a book that you should have and should have been reading you know, by now. Now, I would also strongly recommend that you have some Excel how-to book. You know, there are many good books out there, and you know, and the reason it is important is Excel is tool, and there are many tools in there, and you or I may never be able to master all of them. I don't know all the tools. I'll be honest, on a scale of 1 to 10, if I would look at Excel knowledge, I'm probably somewhere between 3.5. But it's enough to be able to go in and use these tools to be able to do analysis that is going to help you in terms of strategy and also in terms of financial analysis. So this is an example of the book. When I have a few books, you know, both in my house, in my office, at my home, and also at work, this is one of the books that I have used. It doesn't really matter which one you have. You may already have one, but I would strongly recommend you own one, not borrow one. You own one so you can keep it. You keep it, you will need it. If you want to be in the business, you will need a good Excel book forever. So take a book, buy it from Amazon.com, and then start to use it and mark it up. So at least this kind of becomes your dictionary for how to use Excel. Now, so let's talk about what are the outcomes for this intro class finance. My goal is to not get into too deep. We want to keep it at a high level, but you still need to understand some of the nuances. So I will go over income statements. That's a part 2 in the text. You know, there are a few small chapters in part 2. You should read those, and hopefully you have started to do it. I'll talk about break-even analysis using Excel and the PowerPoints. Do a pro forma, which basically means forecasting. Balance sheet, which is the part 3 in the text. I think you should read it. Cash flow, which is the part 4 in the text. Financial ratios, return on investments, and in the end, I will try to put it together from a strategic perspective, trying to link some of the strategic models like the 4 or 5 force and how does it relate to finance. And again, as I mentioned before, in order to keep these modules smaller, I am going to be keeping it, in multiple modules, and so these will be covered in more than one module. So let's start with the basics. The basic financial statements, there are two major ones: income statement and balance sheet. The other one is the cash flow, and there is a fourth one that is not that critical, at least at this stage for you, and that's called retained income statement. In this module, I will focus on income statement, and then later on, the other modules, I'll talk about the balance sheet and the cash flow. So what I strongly recommend, if you have not, that you read the modules, the section 2 in the book, or what section that is in the book that covers income statement, read it, circle it, highlight it, so when you do listen to this, the module, it will make a lot more sense if you have read the book. So I strongly recommend reading the book first before you listen to this thing. Otherwise, I think you will not get as much value out of this thing. I think it's going to take you longer to close any learning gaps that you may have. So before we start to jump into numbers, I think it is maybe useful to think of a business. Let's say a business is bakery. And so we are going to bakery, and let's say our products. Every business has a products or service. We will, for this example, presume it's a bakery and has got donuts and muffins and coffee. So our bakery also has to deal with competition. It could be another bakery around the corner in the other part of the town, or it could be some large mega competition like Stop and Shop or Big Y, where they have bakeries. So the reason I want to bring that up is, as you are going to go through your journey as an MBA student, and externally outside, as you start to think of developing strategies for a business, you want to always keep in mind that we are limited to what we can charge, and sometimes constrained by how much we can sell based on who is out there competing with us. So that that is a strategic thing that you will also start to pick it up when you are also reading the Porter model, which is the other textbook in this course. So let's start with the income statement. What are some of the basic pieces in an income statement? And so I will talk about each one of them very briefly, and then we are going to use some numbers. So maybe if I do it both conceptually and then talk about the numbers, you're going to start to feel comfortable. And again, like I said, I hope you have read those chapters before you listen to these modules. So sales is basically money that we get for selling a product. It could be your donuts, could be your coffee, it could be your cakes. If it was a salon, it would be a service. It could be an accounting service, it could be a legal service. And then in the income statements, they break it out into, they take all the costs and kind of break it out into chunks, modules or pieces of the cost. The first one typically you're going to find is a variable cost, or it may be called cost of goods sold. And as you read the book, it will say sometimes some companies may call it cost of revenue, and then so the lingo may be different. So, depending upon when you're working for a company, you want to find out what do they call it. But what really matters is that why is it broken out? The reason it is broken out, it is those costs that are considered to be directly related to making the products or providing the service. Now, the other pieces of the cost, they would put it in a bucket called operating expenses or operating costs or just expenses, or sometimes, they may call it fixed expenses. This is the money that is spent to run the business, your utilities, your rent. Interest is the amount of money we pay the bank for the money we owe them. And then obviously we pay the taxes to the Uncle Sam, and then whatever is left over is a net income. So what is net income? Net income is a profit. It's how much profit we make, we have left after all the expenses, interest, and taxes from the sales we collect. So let's say, for example, we have 3 products in our business, and like I said, you'll say it's donuts, coffee, and cakes. And each one is sold for $1 for donuts, $2 for a coffee, and cake for $10. And let's say in a year, obviously numbers may be higher, but just to kind of keep the numbers simple, in a year we sell 10,000 donuts, 3,000 coffee, and 500 cakes. So if I want to know my sales, obviously it is price times the quantity. So in this case, it's $10,000, $6,000, and $5,000, a total of $21,000. And let's say in order to entice our customers, we may have some discounts, some coupons. Could be like if you get 10 cups of coffee, you get the 11th one free, or anything like that. So those you want to capture it, obviously, in your discount and so on. So the net sales is what you are eventually getting after you have given the discounts of the coupons and so on. So in our example, our sales is $20,000. So what is sales again? It is really what we sell, at what price, and how many we get the sales. So profit now. Now the profit is you take our sales, in our case is 20,000. All the cost to run the business is the profit. Now what the companies do, and it does make sense, they will take the total cost and also look at it into two buckets: variable cost and the fixed cost. And the variable costs are basically called cost of goods sold, the cost of revenue. Again, these are costs directly related to making the product or services, and the fixed costs are the ones that basically, for all practical purposes, stay fixed from month to month or year to year, except for maybe inflation. So some examples of a variable cost and a fixed cost. A variable cost, also called cost of goods sold or cost of revenue, these are costs directly related and is dependent on the quantity. More you make, more you have to spend. For example, if you're in our bakery, more we sell donuts and cakes, more flour we need, more sugar we need, more butter we need, more frosting we need, more coffee we need, etc. Fixed costs of the operating expenses, or sometimes I'll just say expenses, are things that are not dependent on the quantity or the volume, like rent. Sell one donut, 1,000 donuts, a rent will be the same. The utilities, your taxes, your insurance, and so on. Now, sometimes some of these things may not be perfectly fixed. For example, utilities. I mean, they could vary from month to month depending upon the season, depending upon how much you're using the equipment. But for all practical purposes, comparing it to something that is very variable, these are relatively fixed. Now, as long as we capture in our income statement all the costs, and it doesn't not that important if you end up with some of these things over here and vice versa, that is not that important. What is important, you capture the whole thing. But as a business, in order to manage it, understand it, sometimes it is beneficial to break out what is variable and what is fixed, but at least we get a feel for how much money do we have to really come up with, at least cover our fixed cost. So let's say in our example, we have 20,000 in sales, selling our donuts and coffees. And let's say in order to make those, we spend about 10,000. That's cost of goods sold. These are directly related to making a product. Now, in order to run our business, we'll have some operating expenses or some fixed expenses like maintenance, 200, rent, utilities, internet, phone, insurance, salary and wages, cleaning costs, etc., etc. Depreciation, I will talk about it in the next couple of slides. But these are basically all our fixed costs. So now, so next thing you will find in an income statement, a line item. There are a couple of line items that you'll typically find. One is right here, the gross margin. The gross margin is there to identify how much do we have left over after we have spent making our donuts and coffee from the sales we collect. In this case, it is 10,000 to make it. We collected 20,000, so we have 10,000 left. Now, sometimes companies may call this thing contribution margin, sometimes they may call it manufacturing margin. But the whole idea really is to see how much you have left to be able to cover your fixed expenses. So from there, we looked at our fixed expenses, and then we subtract all these fixed expenses, which you add them up, comes out to be $74.90. We are subtracting it from the 10,000. What we have left over is $25.10, and that is called earnings before interest and taxes. Now, again, as you read the book, you're going to find that there are profit, earnings. They're basically synonymous. And so at this point, you can think of it as profit before you pay your interest and taxes, but typically the lingo you will find is EBIT, or earnings before interest and taxes. From there, you pay your interest. So now you have taken the interest piece out. Now you're only left with EBIT, EBT, which is the earnings before taxes, or profit before taxes. In this case, it's 210. And for example, let's say a tax rate is 30%, which means of the money we have over here, we pay 30%, and again, that will vary from business to business, but in this example, I'm presuming it is 30%. So now your net income is $15.47. So this is the basic income statement. Your revenue comes from selling the stuff, cost of goods sold, or variable cost for making the product, what is left over to cover the fixed cost. From there, we got the earnings before interest and taxes to see if we can cover the interest. Then we look at the money before taxes, we pay taxes, and that's the net income. Okay. Now I will be using this particular example a few times. So that's the reason I'm spending some time going over this thing. Now let's talk about depreciation. Depreciation is one item, and I think when you read the book, and if you have not either taken an accounting class or a finance class in your undergraduate, or if you took it some time ago, it may be a little fuzzy. So I just want to spend a little bit of time on it, but I would also tell you that if it sounds confusing, don't worry about it. We don't expect you to become a master at it, but at the same time, as a business person, you should be aware of what it is. So when you're having a conversation with somebody, your accountant, your boss, whoever, at least you would know when you're looking at a financial statement at work, what is depreciation? Okay, so let's talk about depreciation. So what is depreciation? And why is it included as an expense? So when a business acquires an asset that has life longer than 1 year, the total value of the asset is expensed over longer term. Now the question then comes up, how long? Well, it could be 3 years, could be 5 years, could be 10 years, could be longer. So it really depends on the type of the asset. And the IRS has asset codes, and so the accountant in your company or your accountant, whoever, will be able to figure that out. So for us as business people, for us who are learning finance, we are not accountants, but it's still good to be aware of what it means, because that kind of becomes part of leadership and management. So at least you're aware of it. So at least in a conversation that you're having with somebody, you can ask the right question. So let's say, for example, in 2012, we buy a industrial oven, and it's going to cost us up to, including sales tax, of $3,030.30. And for example, per IRS schedule, this particular equipment has a depreciation schedule that will depreciate like this. So this is a real depreciation schedule that I just picked as an example. And using the depreciation schedule, our accountants will figure out what is going to be the depreciation for each of the years. So for example, for 2012, when we bought it, a depreciation expense will be 33% of this amount, which is $1,000. The next year will be 45% of that amount, which is $1,363, and so on. And this is what you will find in the income statement. An income statement is depreciation expenses that are depreciated. Now, a couple of the things I want to bring it up over here, because I will use it again when I talk about the balance sheet in one of the future modules. And also, as you're reading the book, you may read about it. So accumulated depreciation, which is used for the balance sheet, basically means that you are taking your depreciation at the end of the year and figuring out how much did I already expensed out. So year one, obviously we expensed out 1,000. By the time you get to the end of year two, we have spent 1,000 plus 1,363, so we get 2,363. By year four, 2,363 plus 454 is 2,818, and so on. And finally, the book value. Again, at the end of period, what is the book value? At the end of the period, the book value was we depreciated the value of the equipment by thousands. We are left with this number, which is really this number minus this number is that number, and so on down the line. And so this is what you are going to find in the balance sheet, is the book value of the equipment, or you may also see something called accumulated depreciation. So depreciation is one item. You're going to find it both in the income statement as an expense and also in the balance sheet to see what is the book value of your equipment. So in this example, by the time you get to 2015, there is no value left from a book perspective. Now, it doesn't mean the machine has no value. You could still be using it, and you can still sell it for some discounted price. But as far as the book value is concerned, it is now zero value, and hence after the book value goes to zero, there are no more depreciation expenses left for that particular equipment. So I wanted to make some key points on depreciation on this chart. This chart over here is the same one that I used before. I'm just bringing it on this page so that at least we can see it again and not have to go back and forth. So key points: depreciation expense that is in the income statement will depend on the depreciation schedule, and that's per IRS. You don't have to worry about it. If we give you some problems, we will tell you what the depreciation is, but I think you should be able to be aware enough that you can have a conversation with somebody about this subject. And it does play a role when you talk about the cash flow, and when I get to the cash flow, I'll touch on it. So again, not to get nervous. If this is the first time you're hearing it, please read the book, but just be comfortable enough that you can at least be knowledgeable of what I've talked about so far. We spent $3,030 in 2012. So a cash flow, the money we spent, we had to take the money out of a bank and go pay it, was total of $30,030. So let's say we went to Home Depot to buy it, they got us $3,030. But when we expense it, because it has got a life of more than 1 year, we only expense based on the schedule, and in year 1 we only spent $1,000, in year 2 and so on. The rest is expense in the future years again for the schedule. This is why depreciation is called a non-cash expense. So if you read the book, it will talk about it. Hopefully now that you're listening to this thing after reading the book, and then maybe you have to read the book again, you're going to start to understand why they call depreciation non-cash expense. Why? Because, for example, in 2013, we will have a 1363 as an expense in the income statement for that year. But we're not spending money. There is no cash that we spend. Cash was spent in 2012. So this number and these numbers, they become a non-cash expenses, and they are there, they're called accounting expenses. So I am going to do is to stop here at the end of Module 1, and the next thing I will get into is going to be the pro forma income statement. So let's summarize what we talked about. Finance will be used in multiple places. It is extremely important for business people to have knowledge and understand. In the intro class, we will cover some basics in week 4 and week 5. But I think it is important that you keep track of your knowledge, because you will be applying it. So keep track of your notes, have a good Excel book, and until this way, as you go forward in the program, you can go reach back to your knowledge base and be able to refresh it. So next module, I will be using Excel to talk about the pro forma income statement. I will start back from the income statement, which is to talk about, and I'll pick it up from there. So